You're probably sitting on your phone, doom scrolling right now, wondering what's going on in Australia and the world economy, and is it all going to collapse? And how on earth are you going to create wealth when the market seems against you? And this, my friends, is courtesy of late stage capitalism and where these wealth markets, not just Australia, but the world, are moving towards. Now, before you give up on creating wealth here in Australia and you book your first class trip to Europe and buy the Ford Raptor Ranger, let's talk about realistically creating wealth in today's environment. In this video, we're going to cover three key areas. Where are we in terms of late stage capitalism? Should you buy property right now before it gets too late? And how can we minimize the downside in this current economic situation and maximize your personal upside so you're not retiring and being reliant on the Australian government to give you a pension when you turn 65? It's certainly not what I'm looking for in this current environment. I'm personally wanting more choices, wanting the option to take my kids to school, to work 4 days a week, to have choices in my everyday life. Now, if you've watched my channel for any time, you'll know that I'm not much of a consumeristic type person. I don't promote those first class trips or buying those brand new cars. I really want from creating financial wealth more choices, the opportunity to sow into my church, to give money away to projects that I'm interested in, to build others up in their own investing journey. I think this is a game of abundance. But what the ABC and a lot of these media outlets would say to you is that it's doom and gloom and it's not possible for people to break in the market and it's too hard. And that's because we are moving into a system of late stage capitalism where the rich are getting richer and the poorer are getting poorer. And that leads me into my first point about this late stage capitalism. It's the inequality between each of the working classes. Historically, yes, there were lots of rich, but they didn't control everyone like we're seeing corporations come in and control the markets. And even now in America, you've got BlackRock and these companies controlling entire cities with build to rent schemes. Now what we're seeing is the lower and especially the middle class are being pushed out. Middle class are either breaking through and becoming wealthy, or they're being left where their money is getting them less and less in the everyday world. And this is really due to wage growth. Wage growth has been very poor relative to asset growth over the last 3 to 4 decades. And so this is talked about a lot in the media where wages are growing 3, 4, 5%, while properties might be growing 10, 15, 20% in any given year. And so you're seeing greater disparity with all the money flooding into the assets while wages just aren't keeping up. If you look at our parents and our grandparents, the multiple of income to buy the average home in Australia was 2 to say 4 times. Now, if you're in Sydney or in Brisbane or Melbourne, you're looking at 6 to 10 times average incomes to break into the market. And this just makes it a lot harder for people to break in. This leans into the next topic in this late stage capitalism, which is the housing affordability crisis. I've been having some really good conversations with some builders this week. I'm actually looking at doing 2 new builds, granny flats, which are 100 square meter dwellings in Logan City and Ipswich and Moreton Bay. Those are the key areas that I'm building granny flats at this point in time. And I'm building them in landlocked areas on bigger blocks. And the reason is I'm doing a bit of infill in my own property portfolio because there's not enough supply. It's become normal for everyday Australians to accept a 1% vacancy rate to be the norm, whereas a few years ago it was 3%. And if we look at the housing supply coming on and the building approvals, they're underwhelming relative to the hundreds of thousands of overseas immigrants migrating into Australia. And it's not that we want to shut the borders, but there's just not enough housing supply relative to the amount of people coming in. It's just a straight maths equation. Australia is a country of migrants. I'm a migrant, you're a migrant, everyone's moved here into Australia to create the cities and jobs and lifestyle that we all get to live. But the problem is, to cut up a block of land and to create a new house is very difficult for $700,000, which is the mark for most first-time buyers here in Australia. If you look at land prices, even in areas that are regional, you're looking at hundreds of thousands of dollars just to buy a bit of grass to build a house on. And this is why we're seeing younger people look to buy their first home or their investment properties interstate. Buy in Brisbane when they live in Sydney because you can buy a house for $600,000 to $700,000 here and you can have it as a rent investment strategy rather than trying to pay $1 to $2 million to try and break into an apartment in the Sydney market. The same goes for a lot of the regional hubs. You've got a lot of interest in the Townsvilles, the Rockhamptons. I've got property in Coffs Harbour. You've got Port Macquarie, Newcastle. There's a lot of major hubs on the East Coast. You've got Perth and Adelaide as well on the west and south side. So there's a lot of options for Australians. And this is where people are moving, to affordability. And that's why the properties that I'm buying and a lot of clients are buying as investors are in the affordable pocket, because you're going to not get too much rental compression. And there's just not enough supply in these suburban areas. The third key item to talk about is politics. And this is going to be pretty spicy for a lot of people to even mention politics in a video like this. Whether it's Liberal, Labor, or Greens, and you want to have rent reform, the issue is that politics have dabbled in policy around negative gearing benefits and capital gains tax exemptions. And all of these historic laws are likely to go unchanged. If you look at CGT, capital gains tax on the own home, someone in Mossman in Sydney with a $25 million home, they can get any gains on that tax-free. And so what an advantage it is to someone to have a $30, $40, $50 million home, which is where some of these big prices are going, and they make a gain of $5 million and it's all tax-free. Mum and dad on a $600,000 home might make 50 grand tax-free. And so the really interesting thing is these high net worth individuals and families who have 5, 10, 15, $20 million homes, if they make these gains, they're capital gains tax free. And then you've got the negative gearing debate on top of that, where doctors, principals, police, the police force, firemen, accountants, lawyers, all these high income earning individuals are able to use the benefits of negative gearing. And I've certainly gotten negative gearing benefits in my portfolio, but generally Emily and I have tried to be quite neutrally geared as we built out because we didn't want the stress. And at the moment, our property portfolio is very strong, even with the higher interest rates. But for a lot of Australians, the historical strategy has been to buy a bunch of homes, claim depreciation and claim negative gearing if you're a doctor earning $300,000, $400,000, $500,000 a year. I just think the political agenda when it comes to property is unlikely to change. And so people can complain about it. You can complain about the inequality in the wealth classes. We can complain about the housing crisis and how expensive it is to get land. And we can complain about the political instability, which leads me into section number 2 of this video is, should you buy property before it's too late? Now, this argument is very interesting because property is a hedge. It's a hedge against money printing. The money at the end of the day is going to flow into these assets. And so I think, although some people think you shouldn't invest in property at all, I think the system we've talked about isn't going to change. We might want it to. We might want to say that no one should invest in property and the government should provide rental housing for anyone that wants it. But the truth is, this system with capital gains tax, the rich getting richer, negative gearing benefits, they're all likely to play out and stay as they are. The status quo is likely to stay as it is for the next decade as it was the last decade. And so we can go back and forth about that, but it's unlikely to change in my opinion. And so for the everyday mum and dad, which I hope is most people watching my videos, people wanting to create a better life for themselves, should we now buy property before it's too late? Because the status quo is unlikely to change and property is still going to be an investment vehicle for most people. It has been for centuries and thousands of years. Property has been a scarce asset. And my answer to that is yes. And there's a couple of key points around why I would say that. When it comes to buying properties, I get asked almost every day of the week, Luke, is now the right time for me to buy a property? And I break this answer into 2 key points. Have you got the finances and have you got the strategy when it comes to this next property purchase? And so for most people, you need to tick that finance box first. And so that means sitting down with a broker or a bank, looking at the equity in your own home or any investments you might have, and seeing if you've got capital available to put down a deposit. Then, have you got the serviceability? When you add the rental income and you add your income, have you got the serviceability and you've not got too higher expenses, or what mortgage brokers would call as HEM, household expenditure measure? And so if you've got enough disparity in serviceability and you've got the capital, you've got the finances in place, and you've essentially gone out and got a pre-approval. Number 2 is, have you got the strategy? And this is where I think it's really important with this late stage capitalism, is the strategy is some people might get FOMO and just buy anything. And yes, with enough time, 10, 15, 20 years, you can pretty much buy anything in property and it will go up. But if you want to create more choices faster, you need to buy the right assets. And so if you're an average everyday family, you need to buy what you can afford. So you look at your finances, and most of our clients are buying houses between 600K to 1.2 million here in Brisbane. And we buy for a lot of clients 1.2 to 2.5 million. But most of our buyers are going to be between that 600 to 1.2 up to that 1.5 in the inner ring of Brisbane. And so based on the price, then what is the strategy? And for me, my overarching strategy is capital growth first, cash flow second. And the reason is you go for growth first to create the deposits, to create the equity, and maybe a manufacturing value like I've talked about in other videos. And you're creating more disparity between the debt and the value of the property to then refinance, pull out equity, and continue growing your asset base. In my example, my property portfolio sits around about that $8 million mark. And so if I get 10% growth on the property portfolio, that means I made $800,000 of capital gains. And until I sell, I don't have to pay tax. And so I think you should buy a property when it's right for you, not before it's too late, because the market's going to keep moving with or without you. And if you decide, I've seen lots of people over the years regret not making the right decisions because they were too scared. And so I think you've got to get the finances and you've got to get the strategy in place. Now, don't run yourself too close to the wire. You still want to have security and stability, and that's managed by having cash buffers in place. And the way I personally do that is offset accounts. So with offset accounts, I usually put a certain amount of money that I'm comfortable having as a buffer. And when Emily and I bought our first property, I think the buffer was like $3,000 or $5,000. It wasn't much. And then when we bought our second and third, maybe it grew to 10 or 15K. And then when we got our third, fourth, fifth, and we grew to around $3.5 to $5 million, it started being 50K in the kitty. And now with the property portfolio sitting around $8 million, I like to have at least $100,000 of cash in the offset accounts for anything going wrong. You know, I had a shower blow up the other week, so that's $4,000 gone. I've had issues here and there with some of the rain, and maybe there's another $5,000 gone. So to give yourself security and stability, to give yourself confidence, use offset accounts, use your liquidity to your advantage, and build your property portfolio that way. So let's wrap this video up. Let's talk about how we can minimize the disadvantages and maximize the advantages based on late stage capitalism and where Australia's economy is heading. Big picture, there's going to be more people in Australia. There's not going to be any more land in scarce locations. And a lot of the regional markets have grown because building costs have grown. And that's going to continue to happen with money printing. So in my opinion, you should buy what you can afford. You should continue to look to grow the asset base and balance over time. For me, that looks like buying good quality homes here in Southeast Queensland because I'm very bullish personally on the Brisbane market over the next 3, 5, 7 years. And I don't think you should be chasing hotspots, in my opinion, every 12 months for fast growth. My personal approach has been to add value to properties that I've bought with the mid to long-term outlook through cosmetic renovations, pull out some quick equity because of the manufactured value, and then let the market do the heavy lifting over the mid to long term. Now, some other guys out there might say chase the hotspots, get your growth in those locations, keep pulling out money from each of those deals and chase the next hotspot and keep doing that. But over the long term, if you're holding that property portfolio for 7, 10, 15 years, you just want to check the fundamentals that those hotspot areas that you're buying are going to have good fundamental growth over the next 7 to 10 years, not just the next 2 years. So it's about that balance. I don't mind people chasing hotspots for some reasons, but you've also got to look at the bigger picture. And are you making a 12-month decision or are you making a 12-year decision when it comes to your investing? The other thing I hear a lot is concerns about over leverage. Debt is bad, cash is good, and I don't have too much debt. Now, as a Christian, the way I manage my assets and my debt, I want to steward things well. And so I want to look after my tenants and I want to make sure I'm repaying the banks. And the way I avoid over leverage is running your numbers, looking at the rental income coming in, looking at my own personal income and savings, and making sure, like I spoke about before, that I have enough buffers in place. In my opinion, you don't really own these assets at the end of the day. You just get to steward them for a period of your life. 5, 10, 20, 30, 50 years if you're lucky. You get to control property and then maybe pass it on to your kids and pass on some wealth to help them have a leg up. But really, it's about being a good steward. And that's where the chartered accountant background that I have is a huge advantage, because I'm a buyer's agent. I'm a registered chartered accountant. I used to work for a property developer. I used to work for an auditor. So I really have the inside lane when it comes to both running the numbers and finding good quality deals. And that's what it comes down to at the end of the day. If you're an average Australian family, you're going to need somewhere between 2 to 4 homes to set yourself up for more choices. One property, one investment property, unless it's a commercial property worth $5 million. For the average residential investor, one property for $1 million isn't going to be enough to get you into your retirement phase. You're going to need somewhere between $2 to $5 million worth of assets, compounding, maybe selling down some of those assets and adding cash flow to the others, like adding granny flats, to really give you an end game property portfolio and work, with the markets based on what's happening with money printing and where the economies are heading. Now, to round this out, yes, we could have a property crash. We could have a global financial crisis in the next decade, and there'll be more crises and more wars and more things going wrong. It's just the nature of society. But if you look at history and you look at what's happened in those worst case scenarios, properties tend to drop 5, 10, unless you bought in a mining town, 50% in mining towns. But for most capital cities, the big drops in those worst case events were 10 to 15% at worst. And that's probably pushing it based on the data. So when you look at the upside, and they could grow 5 to 10% a year, long-term averages in Australia are 7 to 8%, I'd much rather bet with history the last 30, 40 years than sit on the sidelines and wait to see what happens. So I'd encourage you, if you want to take yourself to the next level, head over to purposeproperty.com.au and click on course, where you can break down and learn how to build a multi-million-dollar property portfolio. And if you want to buy a property here in Southeast Queensland, head over to purposeproperty.com.au and book in a free chat with myself, where we can sit down and chat specifically about your situation and how we can help you grow and build your property portfolio by buying here in Brisbane in the next 6 months. So I'd love to hear your thoughts in the comments below, and also give this video a click right here, because YouTube reckons that's the one to watch. All right, I'll see you in the next one. Peace.